Hey everyone, it's Rich Warner from WealthMaxBuilder.com. I hope you're doing marvelously well. Today's lesson is Lesson 7 from the Essentials of Investing video course series, entitled So Many Strategies, So Little Time. Let's have a brief look at the disclaimer statement. Thank you very much. There's so many investment strategies out there, almost as many as the number of securities and financial instruments. Let's face it, there are tens of thousands of equities out there, stock to invest in, companies, and tens of thousands of bonds and tens of thousands of ETFs and funds and mutual funds out there that you can invest in. And there's so many strategies, and everybody has their particular way of investing. Then you combine that with the fact that in today's digital world, with all the social media out there and information and digital information and blogs and magazines and websites all clamoring for your attention. And they all have something to say. Financial journalists, hedge fund managers, analysts at these companies, fund managers, brokerage firms trying to encourage the latest fast trading methodologies so that they can rack up huge commissions. It's all out there. There's active strategies, tactical strategies, and then there's the set it and forget it passive investment strategies that this course is all about. We have to keep in mind with the ever-expanding flow of information at our fingertips that to be able to just simply focus on one strategy is next to impossible. So this lesson is really about recapping and reviewing the very essential core points that we should keep in mind as investors. And then once you find a viable, doable strategy that actually makes sense for the average investor, then the hard part is to stick to it and follow it through thick and thin, because it's not easy to do that. It really isn't. But you have to keep your mindset focused on the long-term picture here. And just to remind us as to just how hard it is to stick to a particular investment strategy, I always like to show this study from the Dalbar Group about how the average investor has fared versus the performance of the respective benchmark indices. And as you can see, from this particular sample period from 1990 to 2009, beginning of 2010, the S&P 500, for example, had an average annual total return of 8.2%, whereas the average stock investor only took 3.2% from the markets. That's less than half the performance of the benchmark S&P 500. And in terms of bonds, it's even worse. The average annual return of the Barclays U.S. Aggregate Bond Index was about 7% per annum total return during this same time period, and the average bond fund investor only took 1% from the market per year. That's 1/7 the performance of the benchmark. And when you combine the performances of the average stock investor with the average bond investor and you average it together, that's even less or worse than the rate of inflation of 2.8% per year. So the average investor hasn't done very well against the respective benchmarks. So the fact that we're underperforming the benchmarks by such huge margins tells me, and should tell everyone, that it's pretty hard to just simply follow a very simple passive investment strategy. Something else is going on here. It seems as though the average investor is not doing well timing the markets. It appears as though they're selling off at the market bottoms and they're buying near the market peaks. That's the only way you can account for this lackluster investment performance. Is by simply buying at the wrong time or simply not sticking to a passive asset allocation, which would give you the performance or a mix of the benchmark indices. So what are we supposed to do? How are we supposed to combat our human weaknesses as investors? Well, I always like to remind myself of the big picture. I think this is a good starting point. Remind ourselves that, the main objective is to maximize reward to risk. And as I've discussed in the previous video, the way you maximize reward to risk is you just get a very good asset allocation between stock funds and bond funds. You need little, if any, commodities, and you basically are going for a top investment grade bond fund and a top low cost allocation to stock funds. And once you do that, just set and rebalance once per year. You don't have to intervene, because the more you intervene, the more your performance looks like this here and like this here. And we want this and this. Okay. a mix of the two. Next thing I like to do is to remind investors about the rewards and risks of all the major asset classes. We've seen this slide as well before in a previous lesson. And it's just basically trying to remind us that, stocks are 4 times as volatile as bonds, and their average annual returns, while greater than bonds, you have to ask yourself, how much more should I weight my portfolio to stocks if the worst drawdown is significantly greater than the worst drawdown for bonds? I mean, with 4 times the volatility or risk, stocks should be adjusted accordingly in terms of your weightings in the portfolio. 25% the weighting of bonds is not outlandish. It sounds crazy for young investors, and perhaps young investors can allocate more than a quarter of their portfolio to stocks, and probably should by a little bit more. But the optimal mix is going to be somewhere around that weighting that I'm suggesting. And the optimal mix is right here. Notice how we've significantly cut down on the drawdowns of a potential overweighting to stock portfolios by going with the optimal mix of stock and bond funds. And we're not sacrificing that much with the average annual returns. If you look at the average annual returns, we're talking about 7.5% per annum, 7% per annum, 7.5%, sometimes 8% a year. That's pretty darn good. If you're going to cut back your maximum downside risk by so significantly, I'll give up a few percentage points to do that, in my opinion. And especially as you get older, as you get into your senior years and during your retirement years, especially as you're drawing down the portfolio, you just can't afford, due to a limited time horizon, to be overexposed to equities anymore. You really have to start cutting back according to your time horizon. And the WealthMax Builder portfolio as an optimal asset allocation is an attempt to do just that, to provide all age groups with a very solid lower weighting to stocks, higher weighting to bonds. It's very appropriate for most investors. And on the right-hand side here, we have the CRB index, which, as you know, my feelings about commodities is that you should invest next to nothing in them. The only reason I have 5% gold in there is to combat inflation. So we use gold as an inflation hedge, and we also have a little bit in there to combat some geopolitical risk. And lastly, we have real estate or home ownership. Now, this particular study that I've done here shows that, homes are a pretty decent investment long term, but they do have their downside risk. And this particular bar shows the returns, the average annual total return of real estate, of home ownership in the United States as a cash investment, not as a mortgaged investment. So if we have, let's say, a 4 times equity leverage, to use a round number, if the house costs $100,000 and you're putting down $25,000, that's a 4-to-1 leverage. That would greatly expand the downside risk of this bar. So this particular study assumes that there is actually no leverage, no mortgage in a home. This is straight cash real estate here. And the average annual return for real estate is about 4.5% per annum. So, it's less risky than stocks if you own cash, but if you have a mortgaged investment, then the volatility of home ownership is significantly greater. It actually is potentially scaring, as we've seen in the recent severe recession of 2008. Where some investments in real estate in the United States, in Miami and Las Vegas, were down 75% cumulatively over the period of 2, 3, 4 years. So real estate can be scary if it's leveraged. But if you keep the long picture in mind and invest in real estate for the long haul, you should do fairly well. Know the rewards and risks of all the major asset classes. This table I covered in a previous lesson, and it basically is a good reminder to know what the total average annual returns for stocks and bonds and the optimal asset allocation, commodities, and real estate is versus its risk level. This is another way of showing reward to risk. And we have to back out the CPI rate, which is the rate of inflation, to arrive at the reward to risk ratio, otherwise known as the Q-sharp post-CPI, post-inflation reward to risk ratio. This is the key number to look at. And as you can see, the optimal asset allocation beats all the other investment asset classes. So realize that the optimal mix is the way to go. I also like to take a step back and remind investors about the big picture after inflation. So this chart is a cumulative total return for all the major asset classes that I covered in the previous slide after inflation. So we're backing out the rate of about 3% per annum on average to arrive at these real cumulative return equity curves. And as you can see, the best performing asset class is in fact stocks over very long periods of time. That's the green line, the S&P 500 going back to 1925. The yellow line is real estate times 4, meaning 4 times leverage, meaning a mortgage investment in real estate. But as you can see, just how volatile real estate was during the Great Depression years. Real estate was not a very good investment. And in 2008, we saw this huge bust in real estate prices as well. So over the very long haul, real estate, like stocks, is a good investment. But over very short periods of time, stocks and real estate with leverage, with mortgage, may not be such a hot investment. The blue line is the investment grade bond index, the Barclays Aggregate Bond Index. Notice that it's a lot steadier, and in the Great Depression, it actually went up in value. You have to take a look at the really bad periods as well when you're investing. And the Great Depression was the worst period in U.S. economic history, when stocks actually declined by 85% cumulatively from 1928 through 1932. The stock market went down a cumulative negative 85%. That's huge. The only place to hide were Treasury bonds. And Treasury bonds, as you can see, actually went up during this period. And they also went up during the 2008 Great Recession as well. So Treasury bonds are integral to maintaining a balance to your overall portfolio. And that's what the purple line is. The purple line is the optimal asset allocation between stocks and investment grade bonds. And as you can see, this particular equity curve, the purple line, is the most balanced, least volatile line on this chart. That gives you the highest return, the best reward for your risk. And the brown line is real estate without a mortgage. This is unleveraged, cash-only investment in homes. And as you can see, it hasn't done nearly as well as the investment grade bond index. So if you're not ready to invest in real estate, for whatever career reason or familial reason, you shouldn't feel bad. You can always invest in a Roth IRA for your retirement. Build equity, build growth, take advantage, harness the power of compounding to your advantage as early as possible. You don't have to invest in real estate to become a millionaire by the time you retire if you start in your 20s. You could do very well, just fine, thank you, with an optimal asset allocation like the Wealth Max Builder, which is the purple line right here. And last, we have commodities in red. And as you can see from this chart, the returns from the CRB index are actually negative cumulatively. We're talking negative real returns in commodities. So why should you be investing in commodities at all? As I mentioned, I am a reluctant investor in gold, but I only have it there as an inflation hedge and also for geopolitical risk. Otherwise, I would stay away and completely away from commodities. You're better off balancing a mix of stock funds and bond funds. Here's a reason why the optimal mix does better than either stocks or bonds. Again, we have here the Barclays Aggregate Bond Index from recent history since about late 1990s on through 2017. And as you can see, the Aggregate Bond Index is, pretty steady Eddie compared to the volatility of the S&P 500 in yellow. So the blue line is the investment grade bond index. The yellow line is the S&P 500. As you can see, bonds are not as sexy. They don't get all the attention, the limelight that the stock market does. But you know what? Boring is beautiful for investors. Now, you do have to beat the rate of inflation, which is why we even bother having stocks in our portfolio. It's to take advantage of highly competitive companies. But the bottom line is that bonds give you the stability that you need. And the other reason why bonds are so important is because they give you this yin-yang effect. When the stock market is doing terribly in the downward trend, like these red lines in the lower chart, the Treasury market is rallying. Okay, so when stocks go down, bonds go up, treasuries go up on a long-term basis, not on a day-to-day basis, but on a long-term basis. And when stocks do well, bonds tend to go into a bear market. But keep in mind that even as the bonds come off and they're going into a bit of a pullback, they're still paying interest. So it's that interest factor that's smoothing out the overall equity curve, and that's why we get this smoother curve over long periods of time. So it's really like a yin-yang that's going on between bond funds and stock funds. Here's another visual representation of what I just mentioned, how stocks are inversely correlated over very long periods of time. From 2000 to 2002, Treasuries rallied hard. This happened again in 2008. Treasuries rallied hard as the stock markets of the world got crushed. And as you can see, the yin-yang effect, when bonds are doing badly, stocks are rallying. When stocks are doing badly, bonds are rallying, particularly treasury bonds are rallying. So we definitely need to have these treasuries in the portfolio to give you stability over long periods of time. And the last major point of this lesson is don't forget your portfolio math. Remember that, just as we're seeking to get high returns, as high as we can for as little risk as possible, it's very, very important to keep your drawdowns, your annual pullbacks in your equity and the portfolio value, to keep it under 10% per year. I mean, that's the target that I strive to get with the optimal mix. I don't want my annual returns to ever go below 10%, because as you notice, that if you get a 10% drawdown, let's say in a year, you only need about 11% return to get back to break even. And the worse the drawdown is, as this column is trying to show, and the worse the drawdown is, the more exponentially higher your returns have to be just to get back to break even. So, as I mentioned, 10% drawdown, about 11% will get you back to break even. But what if you had a 50% drawdown, as we had during 2008? Even Warren Buffett was down 50% in 2008. Well, guess what? His Berkshire Hathaway fund and all equity investors in general needed about 100% to get back to break even, not 50%. If you ask most people who are not mathematicians or mathematically inclined, and you ask them, how much of a rebound do you need from a 50% drawdown? They'll say something like 50%, right? No, that's not correct. When you think about it, after you cut your pie by 50%, you need another 100% of that 50% that's left. You need 100% of that to get back to where you started. So you've cut the pie, you've cut the dough, let's say, in half. Well, you need 100% of that half remainder to get back to break even. And the reason this is so important is that it takes significantly longer to recoup a 50% drawdown than it does a 10% drawdown. For example, you can recoup a 10% drawdown in 2 years, or even less sometimes. But to recoup a 50% drawdown, you'll need something like 8, 9, 10 years to get back to break even, sometimes even longer. I mean, in the Great Depression, if you had experienced an 85% drawdown, you would need something like 600% return to get you back to break even. And that's going to take you about 20 years at least. Which is why stocks should not be heavily weighted for seniors. Older people who have a more limited time horizon for their investment portfolios should definitely scale down stocks because, what if we were to go through another great recession? It's possible, never say never. And so you would need 20 years to get back from a severe depression. The math is very important, and it's one of the biggest reasons why we have to get the asset allocation mix just right. Okay, so to summarize, the key takeaways from Lesson 7, this review lesson that I think is very important at this point as part of the Essentials of Investing video series. Okay, point A, now more than ever, we need to learn how to focus on the big picture and not get swayed or tempted by all these various investment opportunities and strategies and trading strategies, market timing, and all of this. It's very hard, but it's integral for your long-term success to stay with the big picture and the long-term passive investing aspects of this particular methodology. Point B, human intervention is one of our worst enemies when it comes to investing. So many times I've seen it time and time again, even with Federal Reserve chairmen who go in and out of the market, timing their interest rates and all of this, when interest rates should have been left alone, or, certain Fed governors, they intervene too much thinking they do better that way. No, it's not necessarily the case. Sometimes human intervention is our worst enemy. We have to just learn our weaknesses when it comes to market timing and not try to get in and out of the markets. It's much wiser to go with the long-term asset allocation optimal mix and set it and forget it. Point C, remember that the grand objective here is to maximize reward to risk. It is not necessarily to hit it out of the park, to get the grand slam, to get that incredible investment that's going to give you 15% per year or something like that. That's not what this is about. If that's the type of investor you prefer to be, then the optimal asset allocation passive investment strategy is not for you. Point D, know the strengths and weaknesses of each and every major asset class, as well as your overall portfolio mix. By that I mean know what the average annual returns are, know what the maximum return was, total return in any given year, know what the worst years were like. I think if you study the worst years, you're better prepared as an investor. Don't just focus on the upside. Look down as well. Take a look down and be aware of just how scary the downside can be. It'll help you balance your asset allocation mix much better. And this coincides with point E, which is know the Q-sharp ratios, which is simply the reward to risk ratios, as we discussed in this slide right here. The Q-sharp ratio post-CPI, post-inflation. Know what the average annual total returns divided by the standard deviations are for each of the major asset classes, and as well as for the overall optimal asset allocation or the optimal portfolio. And once again, point F, keep the big picture in mind. Remember the king of the mountain chart in terms of cumulative real returns. You want to keep the big picture in mind so that even if we get a huge pullback in the stock market, just sit tight. Know that you've tried your best. You've got a good solid asset allocation mix between stock funds and bond funds. You have some treasuries that will offset the stocks in your portfolio. So keep the big picture in mind. Point H, stocks are great. You need them in the portfolio because they do provide real positive returns over the long haul. It's the green line, remember? Over very long periods of time, stocks will do well. And the reason that is the case, in fundamentally speaking, is that companies are out there to compete. They're out there to generate earnings. Companies that don't generate earnings fall out of the major stock indices. It's something known as survivorship bias, which is why you should not be picking individual stocks, but rather you should be loading up your stock allocation, that is, with index funds, because they're low cost and they give you the exposure to the competing companies that are the survivors. When an Enron has to be ousted from the Dow Jones Index or the S&P 500, there's a reason for that. And many of those companies that fall out of the indices eventually go to bankruptcy. But that does not happen to the index funds because the index fund managers have to replace the majorly underperforming companies with survivor companies, with competitive companies. So go with index funds primarily. And by the way, the same concept holds for investment grade bond funds. You don't want to be picking individual bonds from, let's say, underperforming municipalities or corporate companies that can no longer pay their interest or pay off the principal and then go into arrears. That's why it's very important to go with a bond fund that's diversified across hundreds of companies and governments. And finally, point I, remember the portfolio math concept, that huge drawdowns are going to have long-lasting effects. So our goal is to get the asset allocation mix right so that we keep our drawdowns in any given year to less than 10%. If we can do that, we're going to save a lot of time of having to recoup huge losses. That's why it's so important to keep your stock exposure down to a certain level so that the severe downward moves in the bear markets will not kill your overall portfolio. When you have the optimal asset allocation mix and you get the stock bond yin yang balance just right, you should be able to keep your worst down years to less than 10%. And I'll let you in on one little insight. Whenever you should have a down year with an optimal asset allocation, there's a very high probability that the following year is going to be positive. And not only that, it tends to make up for the down years. So that's why it's so reassuring to know that you have an optimal asset allocation going for you. And it's going to keep you balanced through tumultuous times and also give you good returns in the good years as well. Well, that's it for this lesson. I hope you enjoyed it. Up next in lesson 8 is how to reduce your portfolio risk. We've already discussed quite a bit of how to do that in this particular lesson, but I just want to remind traders and investors some key points, key lessons that I've learned over the years, how to reduce your overall portfolio risk. I'll see you in the next lesson. Thank you so much for watching.